What is the best and the safest investment that you can possibly make? Last year, Coca-Cola paid Warren Buffett $736 million in cash, just because he has invested in Coca-Cola back in 1988, $1 billion. In fact, he has been receiving hundreds of millions of dollars from that company ever since. And since Coca-Cola stock has grown from around $2.6 from 1988 to around $61 today, his $1 billion now turned into $25 billion. In fact, this year, he is going to receive anything between $750 to $800 million from Coca-Cola again, and next year and the following year. However, when he was asked what is the best investment someone can possibly make, what do you think his answer was? He said that it's the S&P 500. So why exactly Warren Buffett did say that the S&P 500 is the best investment when Coca-Cola paid him billions of dollars? I mean, he just threw $1 billion into the company, and since then, now he's receiving $1 billion almost in cash every single year from that company without even considering that his investments has grown to $25 billion. So let's try to answer the question, what exactly is the S&P 500? How to invest in the S&P 500? Who should invest in the S&P 500? We will not get into the details of investing and how to analyze stocks because S&P 500 is mostly for the average person. So if you want to know everything you need to know about the S&P 500, give this video a thumbs up and let's dive in. Now, to answer that question, we'll first have to answer a completely different question. Why invest your money in the first place? Now, most people have a general understanding of what investing is. When people think about investing, they usually think about real estate because it's the most direct and straightforward way to actually put your money to work. You take money, you buy a property, and over time, the price of that property keeps rising, and that's what we call investing. You also can receive rental income. For example, if you're renting your house, you're paying money to your landlord. So logically, it's very easy for you to understand how people make money by investing their money in the real estate. But real estate is expensive. Most people cannot possibly afford real estate. In fact, the property you buy is going to be the biggest investment of your life. You're going to take a mortgage for the next 30 years and you'll be paying it off. But besides real estate, it's very difficult for people to understand at its essence what investing truly is. So if we answer that question first, then investing the S&P 500 will start making a lot of sense to you, and you will be able to see why Warren Buffett believes that it's the best investment that anyone can possibly make. Now, to answer that question, we have to take a look at how you make your money first. You might be a video editor, a copywriter, a web designer, a project manager, a lawyer, an engineer, whatever your job is. So you have a very simple formula to make money. You take whatever skills you have right now, then you combine those skills with the time that you have. Let's say this is you, and then you take the skill, you take the time, you combine them together, and you create something that we call value. And now you take this value that you have created and you exchange it in the market for whatever it's priced. Now, if it's priced at $500, you make $500. If it's priced at $10,000, you make $10,000. So this is a very simple formula of making money. Let's say we have a logo designer, and then we have on the other side a copywriter, and we also have a video editor. Now, at first glance, these three professions look entirely differently, and they have nothing much in common. However, if you kind of think about them deeply, you kind of realize that they use the exact same method of making money. At the end of the day, all of them create a certain amount of value, and then they exchange that value for the money that's being priced. So if you understand this simple formula, you start understanding how your money can make money. Because the way you make your money, the way your money and investing makes money is no different than this formula that I just showed you. Let's say we are building a project. And that project is done, everybody gets paid. The logo designer gets paid, the copywriter gets paid, and then your money gets paid as well. And that's what we call investing. Now, by illustrating with an example, it might make much more sense. Let's say that we are developing an app, and that app needs a few skills to make that happen. So what do you need when you build an app? You need, let's say, a logo designer, and then you need a web designer, and you might also need a software engineer in order to make that logo happen. But it's not enough to hire the right talent to build that app, right? You need funding in order to hire those people in the first place. You might also need to rent a place, an office, to bring all those people together. They need computers, they need different subscriptions, and there is a long list of things that they need in order to make that happen. And that's why we need money. Let's say you decide to invest in this business $50,000 to make it happen, to bring all these people together and build this app. When the app is ready and it's being launched, the logo designer, let's say, gets paid $500 for his services. The web designer gets paid around, $10,000 for his services. The software engineer will be paid $20,000 because he made possible this app. And finally, the money that you have invested in this project also gets paid. So everybody brings a certain amount of value into this project by making this app possible. And that's how money makes money. But the question that we have to answer ourselves is that how they get paid in the first place. Why does the logo designer, for example, gets paid $500? So when you answer that question, you start to realize what investing is at its true essence. Let's say we have launched an app and that app have turned into a complete failure. How much do you think the logo designer is going to earn in this case? He's still going to earn his $500 because when he joined the project, he made it clear that I want $500 in order to design you a logo. However, let's just take a look at alternative scenario when we create and launch the app and then the app turns out to be a complete success and it makes $1 million. How much in this case the logo designer is going to earn? He's still going to earn his $500. He's not going to earn anything more than that because he actually asked for a flat fee of $500. But let's assume that the logo designer will tell us that, listen guys, I don't want $500. You're building this app. I just want 1% of the profits that this app is going to generate when it's being launched. What do you think? How much do you think the logo designer now will make once the app makes $1 million? Now, 1% out of $1 million is $10,000 in pure cash. So in the first scenario, the logo designer would make $500, but in the second scenario, because the app turned out to be a complete success, the logo designer will make $10,000. That's a huge difference in the amount of money that they're actually making. And that's why how you make your money will determine how much money you make at the end of the day. Because in the first case, you are actually taking the risk. And how much risk you take will determine how much you make money. So in the first case, let's say you actually charged $500 for designing that logo and the app failed. You're not taking any kind of a risk at all. Like your risk is absolutely minimum. It goes to almost zero. We started the project, you asked for $500, you made the logo, you got your money. But in the second case, you are taking a lot of risk where you say that I'm going to take just 1%. But let's assume a scenario that you ask for 1%, but the project turned out to be a complete failure. You are making $0 anyways. However, because you took such a huge risk and the app turned out to be a successful, you are making $10,000. The same logic applies to how you invest your money. If you take a lot of risk, then the opportunities for you to make a lot of money are much higher. If you lower down your risk to the bare minimum, then you are going to make a lot less money that you could possibly make. So it works the exact same way as you trade your skills and time for money. Now, let me give you an example to illustrate the point much clearly. Let's say that you are going to lend this $50,000 to build this app at an annual interest rate of 20%. So when the project is over, whether it doesn't really matter whether the project has failed or the project succeeded, you're still going to make your 20%. So $50,000 and 20% out of that is an extra $10,000. By investing $50,000 into this project, you're making $10,000. On the other hand, if the app turns out to be a complete success and it makes $1 million, how much do you think you are going to make? the exact same $10,000 because you're going to get back your principal and you will get back the money that you have invested and the interest on the top of that money that you have invested. On the other side, if you decide to take a much higher risk and you will say, listen, I want 20% ownership or 20% of the profits of the business that this app is going to generate. So if the app turns out to be a complete success, like in this case, and 20% of that is what? 20% out of $1 million is $200,000. So besides just making your $50,000 back, you are making an extra $200,000. And that's because you took a much higher risk. And with a much higher risk, the app turned out to be a complete success, and you are making significantly more than the $10,000 in the first case. And that's why whenever you are investing your money, you should always ask yourself a very simple question. How much risk am I taking? Or how much risk am I comfortable to take in the first place? But the problem with that is that you don't really know where is a good investment and where is a bad investment. I mean, when you take a look at all different apps out there, you don't know which app is going to succeed and which app is going to fail. I mean, take a look at the United States. You have around 32,000 businesses all across the United States. And out of these 32 million businesses, 12,000 of them are being traded in the stock market, which means that anyone all across the globe, especially in the United States, can take out their phone, pull out their phone, and buy their stocks and become their shareholders and invest in those businesses. Now, let me ask you a question. Which of these 12,000 stocks are going to rise and which one of those 12,000 stocks are going to fail? But because most people have no idea how to analyze companies, find out their true valuation, make a proper prediction after analyzing their financial statements, they don't really know which ones to invest. Can they gamble and get it right sometimes? Yes. But if you take a look at the statistics, 90% of those people who gamble, they actually end up losing their money. And that's why when we work with our students, we make sure that we teach them everything from the basics to the advanced techniques so that when they analyze a certain stock, for example, they know that, all right, this is the true valuation. So if the true valuation of that company, for example, let's say per stock is $100 and it's being traded at around $70 right now, then sooner or later it will go back to that $100 and they will make a 30% profit out of it. On the other hand, if that stock is being traded at $130 or $150, then it's an overvalued stock. So you wouldn't actually buy it because you know that today or tomorrow or 3 months from now or 6 months from now, it is going to go back to that true valuation. And that's why it's important to know that and learn that in the first place before you start investing in the stock market. Let me give you an example. Last year, we had Big Lots. Big Lots is a complete failure. This stock has been down by over 97%. If you invested $20,000 into this stock, your $20,000 today would have turned into $500. Is that a great investment? Well, I don't think anybody would have wanted to invest in that business in the first place. And even though if you go back, for example, to 2021, there was a huge rise in this stock and it has grown from anything around, I don't know, it was like $8 or maybe slightly more than that to anything above $70. I would say that's a great investment, but ever since it has been falling down. And if you take a look for the entire 2024, the stock has been going down by 97%. It's a horrible investment. Now, some people bought this stock because they hope that it is going to make a comeback, but the only way you know that it's going to make a comeback if you know how to analyze that stock. And that's why most people who ended up buying this company ended up losing 97% of their money, thinking that the company will make a comeback, but they didn't really know the underlying value of that business before throwing that money. Now, let's take another example. Palantir last year was one of the best performing stocks. It has grown by almost 400%. If you have purchased the stock at the beginning of the year, for example, let's say you have thrown $20,000 into this business at the beginning of 2024. Today, it would have turned into $100,000. Is that a great investment? Well, it's a great investment. Now, the question is that how would you know in the beginning whether this is a bad investment and this is a great investment? And that's why you need investing skills. And that's why you need to be really good at picking up stocks. This is a skill. This is something that you can learn. This is something that we teach our students. And we have an entire section, teaching different analytical skills to our students so that they actually know how to distinguish a bad investment from a great investment. Now, some people watch this in the news and they get excited and they go and buy the stock right here when it's already at the top. But guess what? It has been going down ever since by around 15%. That's when the average person buys it, and that's when the average person actually make a substantial loss. I'm not saying that the stock is not going to recover or anything like that, but when you're buying a stock just because you've heard it in the news or somebody talked about it, it's already too late. You have to do your own analysis. No one else will make it for you. Now, let's answer a different and simple question that we wanted in the beginning of this video. What is the S&P 500 at its essence? When you're investing, because you are taking a certain level of risk, and that risk will depend on will determine how much return you are going to make, which stocks are going to rise? Which stocks should you invest in? Based on that risk and reward, you can determine yourself. So we have Coca-Cola, we have Disney, we have Apple, we have, Pepsi, Adidas, Sony, Canon, and there is a long list of all of these companies. Now, let me ask you a question. Do you know which of these stocks are going to rise? Now, looking back at historical numbers, it's very easy to say, oh, this stock, I should have invested in this company. I should have invested in Palantir. I should have avoided Big Lots. I should have invested, in Tesla or whatever. But it's very difficult to do that by looking forward, because no matter how great you are at analyzing stocks, there is always a room for error. And now imagine if you don't know how to do that professionally. Your percentage of getting it wrong goes dramatically higher. And that's why whenever you're investing, you don't want to invest in a single company. You always want to invest in at least like 5-6 companies, or maybe 6 to 15 companies, because if one or two of them will go down and the rest of them will go up, then you are making a profit if you average it out. That's why the more companies you invest in, the better it is. But just because, of course, you can simply invest in 15 wrong businesses in the first place. I'm talking about if you know how to analyze stocks and you pick up individual stocks and you, let's say, do 15 analysis. You do a lot of analysis and you find out that these 15 companies have the highest chances of them to grow, and 2 of them won't actually grow, or they will go down for one reason or another because something happened, something unexpected happened. At the end of the day, you're still making a profit. How about if you invest in hundreds of companies at the same time? Is that possible? Well, it's not possible for the average person who doesn't know how to kind of pick up good stocks, because you can simply pick up 100 bad companies. And that's what the S&P 500 is all about. The S&P 500 is basically a filter. It basically tells you that in order to be part of the S&P 500, you need to pass a certain criteria. You must have a certain market cap. The liquidity of the stock should be at a certain level. The company must be profitable for at least 4 quarters, and it must have solid finances. So if you meet those criteria, you will be part of the S&P 500. So S&P 500 is not a company, is not a bank, is not a business. It's kind of a business in some way if you actually think about it, but it's an organization that created all of these criteria in order to take a look at all of the companies in the United States. So we have 12,000 stocks in the United States that are trading in the New York Stock Exchange and different stock exchanges all across the United States. But if we actually apply the filter that S&P 500 put, so out of the 12,000 companies that are being traded in the US stock market, only 500 of them will pass the filter of the S&P 500. That's what the S&P 500 is all about. And now ask yourself a question. If it's just a filter, why did Warren Buffett suggest to invest in it? So on the other hand, we have funds. Like we have financial institutions who are like, we're going to build like an investment bank, let's call them, and we are going to take investors' money and we will invest it in these top 500 companies that are being suggested by the S&P 500. So we have a company that is called Vanguard. Vanguard is a financial firm that said that we're going to build up an entirely different department and we're going to invest in the S&P 500. That's why you always hear about the Vanguard S&P 500. But it's not the only company that invests in the S&P 500. We also have Fidelity. We also have iShares by BlackRock. And there is a very long list of companies that invest in the S&P 500. And regardless of any of those businesses that you invest in, you are indirectly investing in the top 500 largest companies in the United States. Who determines those 500 companies? The S&P 500 index. And how do they determine it? They have a long list of criteria. You can simply Google it out and you'll find out all those criteria and you will know why you have invested, why S&P 500 particularly chose this company, for example, over the other company. And another thing they do is that they try to make sure that they don't actually include all the companies from one single industry. Because if you take a look at the US stock market, you realize that the tech industry makes up the majority of the US stock market. But the S&P 500 wants to represent the entire economy. And that's why they only can take a limited number of companies from the tech sector. They also need to take a limited number of companies from energy in such a way that the portfolio is diversified and represents the entire US economy. Because right now we are investing in a lot of companies, what kind of returns can we expect? Remember in the beginning of the video, we talked about that, the higher the risk, the more the return is going to be. But now we are investing not in one company, not in two companies, not in three companies, but rather we are investing in 500 companies at the same time. How much returns can we possibly make from that business? What are the chances that these 500 companies at the same time are going to go to zero? For top 500 US companies to go to zero, the entire US economy must collapse. And if you take a look at the numbers globally, the US economy is the largest economy in the world. The US economy is the most powerful economy that has ever existed in the world. And the US GDP has been growing steadily over time. Even though, for example, European economies have stopped growing since 2008, the US economy has grown from like $14 trillion in GDP to around $27 or $28 trillion right now. And if you take a look at the projections, the US economy will keep growing because if these top 500 companies will disappear for the US economy must collapse entirely. So we know for a fact that chances that the S&P 500 will go to zero and will collapse entirely is close to zero. On the other side, what are the chances that all these 500 companies are going to grow by 200%? And that's not going to happen because for that to happen, the US economy must grow by what? 30, 50, 70, or maybe 100%? That's also not happening. And that's why expecting that all 500 companies in the United States are going to grow by 200% is close to zero. So what is the most realistic scenario for that? The most realistic scenario is that out of those 500 companies, 50 to 100 of them are going to fall by 30%. Because it doesn't matter, you can be part of the S&P 500, but it doesn't mean that your stock is not going to go down. Maybe you had a bad year. Maybe the industry that company's been operating had a really horrible year because less investments went into that business. Less attention went into that business. Maybe investors were afraid to invest in that business for whatever reason it could be. So 50 to 100 companies will see some negative growth. Their stock can go down by 2%, 5%, 10%, 20%. It's very rarely that a company from the S&P 500 goes directly bankrupt. They can go bankrupt, but long after they have left the S&P 500. Because every single year, the S&P 500 will kind of take another look at the companies that they are suggesting, and they will remove the companies that are no longer profitable. On the other side, how many companies will grow by over 100%? Now, when a stock grows by over 100%, it is a fantastic investment. Like, you don't usually get an investment that grows by almost over 100%. So the example I showed you with the Palantir is kind of a unique example. There are, of course, other companies that have grown by over 100%, but every single year, anything between 3 to 10 companies that can grow by over 100%. That's it. Not all of them do that. And the vast majority of the companies from the S&P 500, around 400 of them, will grow anything between 1% to 50%. That's not really a lot. That's great for most companies. If the stock has grown by 20% annually, that's fantastic, right? So if we kind of take everything that we have over here and we average it out, we might actually get something like 27% like last year. So last year, the S&P 500 has grown by 27%. Is that great? Well, to be honest, that is fantastic for the S&P 500 because you don't usually get those kind of numbers. However, if you compare this 27% to a company like Palantir, then it's nothing because Palantir has grown by 400%. So would you wanted to invest all of your money into this business or the S&P 500? Of course you wanted to invest into this business because a $20,000 investment into the S&P 500 last year would have made you around $5,000. So it would have grown to $25,400. However, a $20,000 investment into Palantir would have grown into $100,000. But how do you find this kind of opportunities? And that's why you should learn how to invest in individual stocks. You cannot simply randomly pick up stocks. Yes, you can listen to some experts here and there, but you have to do that on your own because by the time it's already in the news, by the time everybody is talking about it, that stock is already hyped and it's too late to buy it. And that's why every time you go and buy a stock that's being suggested on the news or by YouTubers or by, I don't know, on Bloomberg or CNBC, you buy it and you instantly see how the stock goes down because you are already too late to the game. But if you want to be early to the game, you should educate yourself and you should analyze the stocks on your own. So when you're throwing your investment, your money into that investment, you know why you are buying that. You know the true valuation of that business. So you could have actually invested in Palantir way earlier, not even last year, probably 2 or 3 years ago, if you know how to analyze stocks. There has been some years where the index has been down by 20%, like in 2022. In 2008, it was down by around like 40%. In some years, it's down not that much, but also if it's down by 5%. And not every single year it grows by over 20%, right? Some years it's like around 10%. So if you take a look at it, on average, historically, the S&P 500 grows by anything between 8 to 10%. So if you're investing in the S&P 500, you're not investing for 1 year, you're investing over a long period of time. And if you take historical numbers over 20 or 30 years, then you can expect anything between 8 to 10%. These are the most realistic numbers based on all the historical data that we have. However, let me give you an example. In 2022, the S&P 500 was down by 20%. But did you know that ExxonMobil during that particular year was up by 80%? How is that even possible that ExxonMobil is part of the S&P 500, the S&P 500 is down by 20%, while ExxonMobil is up by 80%? That's a good question, right? Just because the S&P 500 is down doesn't mean that all of those companies are down, because it represents the top 500 companies. So there are going to be companies that are going to grow by 50, 100, 200% when the index overall is going to crash because most of these companies has crashed. And that's why it's important to know how to invest and analyze individual companies. Let me make it even more interesting. The ExxonMobil in 2024 last year has only grown by 11% or almost 12%. So how is it possible that last year when the S&P 500 was up by 27%, ExxonMobil has grown by 12%, but in 2022 when the S&P 500 was down by 20%, ExxonMobil was up by 80%. That's one of the things that we teach our students. We teach them how they can actually spot such opportunities, how they can take a look at individual companies or sectors or industries and find out if this year they're going to rise or going to fall. Of course, there is always a room for error, but the more you know, the better tools and the skills you have at analyzing those skills, the higher the chances for you to actually pick up the right stocks. Why invest when I'm getting just 10%? That's the question that I frequently get. Does it even make sense to invest? Because if you're investing, let's say $20,000 into the S&P 500 and you get just $2,000 out of it, $2,000 gets you absolutely nothing. It doesn't even cover your rent. It barely covers your coffee probably for an entire year. Probably you spend on coffee much more than that. In order for that to make sense, think of investing in the S&P 500 just like a business. You see, I have started multiple businesses, and when you start a business, you know that in the first year, you're not going to make any kind of money. And if you're starting that business with any kind of capital, you know that you will lose that money whether you want that or not. Like chances of you actually getting it right from the first year is so extremely low that you most likely won't be able to do that. In the second year, you will just understand your industry, you will figure out how things work, and you might actually make some sales and things will start working out. In the third year, you start to delegate everything, because prior to that, you do everything. Like you're a one-man team. You do the accounting, you do the sales, you build the product, you do social media management, you're the head of sales, you're literally the head of everything. On the third year, you start hiring people, somebody who will manage your social media, somebody who will do your sales. So by the third and fourth year, you start making some real money probably. By fifth, sixth, or seventh year, you will have a solid business that is generating maybe 6 figures or 7 figures, and you have a successful business. Now, if you go on and start a new business, it is not going to be as difficult as that. It's not going to take you 5, 6, or 7 years for you to start making real money. You might do it from year 1, or if you want to expand your current business, or if you want to develop a completely new product, it is going to be significantly faster and significantly cheaper because you have the capital and you have the expertise. So when you're investing in the S&P 500, it's just like doing that business. In the first year, in the second year, in the third year, you're not going to make any real return. But because you have something on your side that we call the power of compound effect, those investments that you're making are going to grow compoundly, and over time, they will grow much faster. Let me give you an example. So a $10,000 investment where you contribute around $1,000 every single month into that portfolio with a 10% interest rate, in the first 7 years are going to grow into $138,000. So 10% out of $138,000 is $13,800, almost $14,000. So first year you generated $2,000. Now you're generating $14,000. That's already some real money. Now, in the next 7 years, which is year 14 already, those investments are going to grow to around $388,000, almost $400,000, given the fact that you continue investing just $1,000 every single month. And now 10% out of this amount is what? Is $38,800, almost $40,000. That's already the minimum income. This money probably already covers your rent. But if you keep investing, that investment with the power of compound effect is going to grow exponentially. And by year 2022, it is going to grow to almost $1 million. And 10% of this is going to be $100,000, which is a decent income to live in the United States, not at least right now. Maybe by that time inflation is going to eat it away, but you can clearly see this green line is the amount of money you are making out of your investment, and the blue line is the amount of savings if you have actually taken that money and simply saved it. So you will end up with around $200,000 if you simply save that amount of money. But if you have invested that money, those $200K would have turned into almost $1 million. Waiting 20 years to make $1 million out of the S&P 500 is a very long time. I understand that most people do not want to take that path. But again, remember, you're lowering down your risk. You're not investing into individual stocks where you have chances of losing your money. Of course, you can kind of become an investing expert and start picking up stocks, and in a single year, you will turn $20,000 into $100,000 or $100,000 into $500,000 if you actually learn all of that. But again, you are increasing your risk. Of course, by becoming a master at investing, you're lowering down your risk anyways. But if you don't want to take that path and you simply want to invest passively, you can simply get into the S&P 500, and over the long run, you're actually guaranteed to become a millionaire and be financially independent. And that's why Warren Buffett believes that if you're not an investing expert, if you don't want to get into that, simply throwing your money into the S&P 500 will actually guarantee you a financial success. Thanks guys for watching, and I will see you in the next one.